Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're diving deep into Citigroup, ticker C, a stock that's recently been, well, an absolute highlight, hitting new 52-week highs. Our mission, to pull back the curtain, uncover the real story, and we're basing this all on our research from September 9, 2025. Is it possible to be the life of the party and still have your wallet whispering that maybe you're overspending? That's really the question we're asking about Citigroup today. And I guess to even start answering that, we need to look at the broader economic party Citigroup's attending right now. This morning, futures are looking, well, cautiously optimistic. A slightly green open. It almost feels like the market's putting on a brave face, doesn't it?
It absolutely does, yeah. And what's fascinating, I think, is while the market seems, ready to edge up, our research actually reveals a much more complex macro story brewing underneath. Economists are talking about a hidden recession. And these aren't just abstract ideas, right? For a bank like Citigroup, a weakening labor market, well, that could mean higher loan defaults down the line. And stagnant consumer spending, that hits their credit card business, transaction fees. It all adds up. Plus, we've got that key non-farm payrolls revision expected later today. So that positive open, it feels incredibly fragile for the whole sector, really.
Okay, so a bit of an unsettling macro backdrop. Hidden recession talk. Yet Citigroup itself seems to be, operating in its own stratosphere, almost defying economic gravity. It just tagged a new 52-week high. $97.50. And they're making some seriously impressive strategic moves, like that massive BlackRock partnership, managing an $80 billion portfolio. My read on that is it's not just revenue, it's about shifting towards a more stable fee-based business, less reliant on that riskier lending. Is that how you see it too, or is there more to it?
You've absolutely hit on a crucial point there with the BlackRock deal. It's definitely a smart move towards diversification, less capital-intensive growth.
That's right.
And they're also tightening their balance sheet, redeeming $2.5 billion in notes. That shows good management discipline. But this brings up a really important question. How much of that strong execution, that smart strategy, is already baked into the stock price? Because, well, if we connect this back to the valuation, our fair value analysis puts it closer to $84.98.
$84.98.
Yeah. And with the stock over 95, whoop.
That points to significant overvaluation.
Right, yeah. Exactly. Now, Wall Street analysts, mostly bullish, nearly 73% rated a buy. But interestingly, a lone strong sell rating has just popped up. A dissenting voice suggesting, maybe some experts are getting nervous about this valuation disconnect.
Okay, so Citigroup is absolutely owning the dance floor, making all the right moves, impressive stuff. But then we pull out the balance sheet or, well, our fair value analysis, and it starts to whisper, are you sure you can afford all this celebration? Despite that, what's the general market sentiment saying? Is the crowd buying the hype? And, isn't overwhelming consensus sometimes a bit of a red flag?
Overwhelmingly, yes. The crowd is definitely buying in. You look at the options market, it's decidedly bullish. Very low put-to-call ratio, 0.43.
Wow.
Yeah, so for every bet the stock falls, traders are making more than 2 bets that will rise. That shows real confidence in upside momentum. The $97 strike, that's a key target for the bulls, sort of a potential ceiling. And then the $94 strike has a lot of puts, acting like a potential floor. And short sellers, they're practically nowhere to be seen. Short interest is tiny, just 2.2% of the float.
Okay.
But you're right, when everyone is on board, it does make the stock pretty vulnerable if sentiment suddenly shifts.
It sounds like everyone is on board. But okay, what about the charts? What do they tell us? Our analysis noted a strong long-term trend, which is positive.
Indeed, yeah, the big picture trend is undeniably strong. Can't argue with that. But when you look closer, several short-term indicators are, let's say, flashing signs of fatigue. The volume story, for example, is particularly conflicted. We've seen strong money flow recently, which is positive, but deeper analysis shows accumulation, the conviction buying, hasn't really kept pace with the price rise.
So money's flowing in, but maybe not the really committed long-term money.
Kind of. It suggests that while money is coming in, the smart money isn't loading up quite as aggressively as you might expect given this run. Momentum, too, it's clearly waning. The stock's lost that sort of explosive upward power. It's leveling off. And finally, volatility. It's coiling, almost like the spring tightening.
Coiling? Meaning?
It often signals a big price move is on the horizon, though the direction itself, well, that remains a mystery until it uncoils. Could be up, could be down.
Okay, let's try to unpack this then. We've got all these conflicting signals, right? The company strength, the bullish crowd, but then those macro headwinds you mentioned, the overvaluation concerns, and now this technical fatigue. What's the recommended strategy here?
Well, given all that, our verdict is really a wait-and-see approach. We have this direct clash of powerful forces. You've got fantastic company-specific news and really bullish sentiment on one side, and on the other, a, frankly, grim macroeconomic backdrop, a stretched valuation, and clear technical exhaustion showing up on the charts. Pushing aggressively either way right now feels like a gamble against a pretty strong opposing force. So for the next few trading sessions, the key levels to watch are really $97 for the bulls.
Right. Need to break above that confidently.
Exactly, and $94 for the bears to push below. Those are the battlegrounds.
It really feels like Citigroup is that star athlete, just shattered a world record, the crowd's roaring, but the athletes at the finish line catching their breath.
That's a great analogy.
But the deeper question for you, the investor, is, can even the most strategically agile company truly outrun a weakening economy? Or is this current momentum just, creating a higher pedestal to fall from if that storm finally wakes?
It definitely challenges our understanding of corporate resilience in times like these.
That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.